Eris, we were just talking about your view that we will likely start to see the SEC regulate the crypto digital asset world, broadly speaking. I'm assuming you would think that that's a good thing, that kind of gives some credibility and stability, perhaps. I think that I still wonder, though. I mean, one of the reasons why the crypto Bitcoin world exists is because they want it to be more of an open system, less regulated or impacted, I should say, by institutions like the SEC or central banks. So it's a bit of a dichotomy, isn't it?
Well, when you think of it, I mean, Bitcoin back in 2008, when you read the Bitcoin treatise, it's clearly a protest treatise, and it was written, in no small way in response to the global financial crisis arising from the collateralized debt obligation market in 2008. So you're absolutely right. There's a libertarian contingent, the Austrian economic school approach to currency embedded in the mindset surrounding Bitcoin. And yeah, I think, the technical issue, and it goes to the philosophy of the entire Bitcoin space. The technical issue that you hit on, Catherine, is if you remove lawyers, accountants, bankers from the transaction set, which is what distributed ledger technology is all about. I mean, we're talking about decentralization of decision making by replacing those traditional intermediaries with code effectively. And these codes are in the form of algorithms that enable execution of smart contracts. So your ability to transact moves from traditional intermediaries, facilitators, to code. And we all know that code is only as good as its comprehension of the cause and effect arising from that particular issue. And we also know from many years in the financial markets that trying to contemplate cause and effect fully where financial assets are concerned is extraordinarily challenging. Some of your viewers will remember the PhD motivated excellence at long-term credit, which was a can't miss till, standard deviation events meant it was a pure miss, and there was massive destabilization of the market. So I think one of the challenges currently is how do you marry decentralization based on code and the accompanying notion of the immutability of the ledger with the need traditionally in financial services for the ability to interrupt for two things: to validate the client for fraud mitigation. So you have KYC and anti-money laundering, which are fixtures of the regulated environment, which are, obviously very important. So that regulation, to me, is vital. But when you come back to the technology, the central question is, will the code in the smart contracts evolve sufficiently so that we get ongoing generational improvement in the smart contract code? Because if you look at an algorithmic stable coin like Terra and its sister coin Luna, that relationship was based on an algorithmic hedge. And while that hedge held up through lots of market iterations, with the volatility in early May, we saw that algorithmic hedge break down and 60 billion of value vaporized from the market. So it'll really be, how do you ensure fraud mitigation through validating the customer in a decentralized environment? And just as importantly, number two, how do you pattern interrupt a transaction? Because on the blockchain, of course, the transactions are immutable. Once done, they cannot be altered, which makes that very attractive in a country where a despot may come into power and try to change the land registry. It's one of the things blockchain is designed to prevent. But that immutability means you can't reverse a transaction. And reversing transactions is literally the lifeblood of the transactional world of finance.
We'll take a quick break. We'll be right back.